The yield curve is the most important thing to understand in bond investing. And this video will take you from not even knowing what it is to understanding it better than anyone you've ever met. I'm gonna start at a high level, which is, what is the yield curve? Then I'll dive into which factors determine its shape, and at the end, I'll show you how to read the yield curve like a crystal ball and determine what today's yield curve is telling us about the future. This video will have major implications for both bonds and stocks in 2023, but it will also help you identify investment opportunities for the rest of your life. Let's dive in. The yield curve shows what bonds are yielding at different maturities. By far the most common one to look at is the US Treasury yield curve. So that's what I'll refer to today. Here's an example of what a normal yield curve looks like, using the one from May 13th, 2018. In a couple minutes, you'll see why I wanted to show you this one before getting to what it looks like today. Each of these dots represents the yield of a treasury bond with a different maturity. So starting on the left, a 1-month bond was yielding about 1.65%. Moving a few points to the right, a 5-year bond was yielding about 2.8%, a 10-year bond was yielding about 3%, and so forth and so on. It's called the yield curve because when you draw a line that links the yields together, it normally forms a curve like this one. I keep saying the word normally because yield curves like this one are referred to as normal yield curves, meaning the curve goes up as it moves further to the right, with the longer term bonds paying higher yields than the shorter term bonds. I'm gonna spare you the academic explanation of why this is and give you the real world, easy to understand version instead. Why do you normally get paid more for long-term bonds? Because stuff happens. When you buy a bond, you're loaning someone your money for a set period of time. They agree to pay you interest and then give you your money back at the end. The longer you loan your money out for, the more likely it is that something bad will happen. Here, we're talking about US Treasuries, which is a loan you give to the US government. So it's pretty likely that they won't be able to pay back their debt, because they can print money and stuff. But what if they take on too much debt and have to print a ton of money to pay it all back? Well, that might lead to higher inflation, and then sure, you'd get your money back at the end, but what would it be worth? Well, on a 1-year bond, the risk of them borrowing so much that they create massive inflation and erode the value of your money is very low. In 10 years, it's higher. In 30 years, it's even higher. So on longer term bonds, you have to get paid more to take on that risk that something bad will happen. Obviously, this can be even more extreme with something like a corporate bond that's issued by a company that can't just print money to solve its problems. The higher the risk that something bad will happen, the more interest a bond issuer will have to pay to get investors to loan them money. So the first reason longer term bonds usually pay more than shorter term bonds is that stuff happens. The second reason is that longer term bonds are more volatile than shorter term bonds. This is because they're more sensitive to interest rate movement. This interest rate risk is known as duration. I'll be coming out with a video explaining duration more in depth soon, so you might want to hit that subscribe button now. But for this video, the simple concept is that the longer you lock that interest rate in, the more sensitive your bond's price will be to future rate changes. Think about it. If you buy a 2-year bond paying you a fixed rate of 2% per year, then rates go up to 3% overnight, for the next 2 years, your bond will pay you 1% less interest than a newly issued bond with the same risk that pays 3% per year. That means the price of your bond would have to adjust downward so that the return on your bond and a new bond with the same risk would be the same. They have to be the same, because otherwise, why would anyone ever buy your bond from you when they could get another one with the same risk and a higher return? In this scenario, the new bond would pay you 3% this year and 3% the next year, so 6%. Your bond would pay a yield of 2% both years, so only 4%. But if your bond went down in price by 2%, then the future returns will be the same as the new bond. Instead of 6% yield, it would pay 4% yield and 2% in price appreciation, or 6%, making it equal to the new bond. Remember, the vast majority of bonds are structured to give you back your original investment in the end. So, in this scenario, a 1% move in interest rates caused your bond to go down in value by 2%. But what if instead of 2 years, you'd locked in that lower interest rate for 30 years? Well, then the price would obviously have to adjust down a lot more to make the long-term return even. That's why longer-term bonds tend to have more interest rate risk than shorter term bonds. This brings us to our discussion of what determines the shape of the yield curve and what today's yield curve is telling us. We already discussed that longer term bonds usually have higher yields because they have more interest rate risk. They also have more stuff happens risk. That's a technical term, by the way. So then how could you possibly have an inverted yield curve like the one you see here as of February 10th, 2023? Well, here's the key that's gonna make you so much smarter than all of your friends. The yield curve always reflects the future expected path of interest rates. At any point in the yield curve, you can look at one rate and use that to determine where interest rates are expected to be in the future. If your expectations differ, That's an investment opportunity. Now, let me give you an example using real numbers here. Now, let me just say this is purposely oversimplified. If you buy a 2-year bond today or a 1-year bond today, and then another 1-year bond a year from now when the first one matures, your 2-year return should be the same. Of course, stuff happens, so there's almost no chance that it will be the same, but based on where interest rates are expected to be in 1 year, the returns would be the same. So for example, if you bought a 1-year treasury bond on February 10th, you could have gotten about 4.9%. If you bought a 2-year bond, you only could have gotten about 4.5%. So what does that tell you about where 1-year rates are expected to be 1 year from now? It tells you they're expected to be lower. Why? Because your expected return is the same, or 4.5%, regardless of whether you buy a 2-year bond or 2 consecutive 1-year bonds. However, you already know that on your first 1-year bond, you'd earn 4.9%. So that means that 1-year rates 1 year from now are expected to fall to about 4.1%. A 2-year bond would pay you 4.5% for 2 years, or 9% total. A 1-year bond and then another 1-year bond would pay you 4.9% in the first year, and then the expected rate would be 4.1% in the second year, so also 9% total. The key lesson here is that by looking at the yield curve, you can determine where interest rates are expected to be in the future. What this yield curve is telling us is that interest rates are expected to fall significantly, by nearly 1% over the next year, and even more after that. And more specifically, the 6-month rate and the 1-year rate are about the same. So that means that for the next 6 months, rates aren't expected to move that much. But then, between 6 months and a year from now, the market is expecting the Fed to cut interest rates by nearly 100 basis points, or 1%. That's bold. Remember, the Fed raises rates to get inflation down to their 2% target, and they lower rates to stimulate the economy. So what do you have to believe to think that the Fed will rapidly lower rates by nearly 100 basis points starting in the second half of 2023? Is that either inflation will come down below 2% less than a year from now, or the Fed will make a massive policy reversal and start cutting rates before inflation gets down to their 2% target? Both very unlikely, in my opinion. That is what the yield curve is telling you. But I believe the market is overestimating how fast the Fed will cut rates. The only thing that would make them cut that fast is if we have a much worse recession than what's being priced into the equity markets right now. So what does this mean for bonds? Well, you can certainly draw your own conclusions, but for me in bonds, it means I want to focus on the shorter term part of the curve right now, like in 6-month or 1-year bonds. You're not getting paid as much to buy longer term bonds. And if inflation doesn't drastically drop to 2% in the next few months, which very few people are predicting, then I think there's a good chance the Fed doesn't cut rates as quickly. That would send rates higher in the intermediate part of the yield curve, meaning more downside for bond prices. A fund that I like for exposure to short-term, high-quality bonds is PIMCO Low Duration, which has a ticker of PTLDX. As for equities, well, the yield curve tells you that a lot of positivity is already priced in, which means that if I'm right, there could be more downside risk from here. I see 2 likely scenarios. First, we do get the falling rates, but before that happens, there's a significant amount of economic weakness that's not priced into the markets. That will mean more downside from here, maybe a lot of it, although it would be great for high quality short-term bonds. Second, and more likely in my view, is that the economy slows. Maybe we have a mild recession, maybe we don't. It doesn't really matter. And inflation keeps falling, but not as fast as the market is predicting right now, based on the yield curve. In this scenario, medium and long-term interest rates could go higher. This would likely weigh on equity valuations, especially in growth companies. As an experienced investor, I'll be the first to tell you that there are millions of possible scenarios out there. Any number of factors could overwhelm the things I'm talking about here. I mean, we just had a global pandemic, so can you really count anything out? Nothing is guaranteed, but you can read the yield curve and see what the market is predicting. And more often than not, when something looks out of whack, it leads to a valuable investment insight. When I look now, I see that the market is predicting a bunch of interest rate cuts soon. But when I think about the Fed's motivations for their interest rate decisions, I have a really hard time believing they're gonna do that. Equity investors hate higher interest rates. All else equal, if the Fed doesn't cut rates as much as the market is expecting, that's bad for equities. The only way I see them doing that is that there's a lot of economic weakness that's not priced into the market right now. And that would also be bad for equities. Investing is all about coming up with differentiated insight. And here, my view is very different than what the market is pricing in. The market is pricing in an extremely rosy scenario that I think is unlikely. That makes me want to focus on short-term, high-quality bonds for my fixed income investments and take a cautious approach toward equities right now, especially after the massive rally we just had where they've risen about 15 to 20% over the last 4 months. To be clear, I'm not saying get out of the equity market, because as a long-term investor, you should almost never do that. But I have taken some risk off the table recently, and I'm trying to focus my investments on specific areas where I still see some good opportunities. I like Chinese equities, Indian equities, global industrials, and short-term, high-quality bonds. I've recently published videos talking more about those individual opportunities, and I'll link them in the description below. By the way, I make this content to help transform Americans from beginner investors into expert investors. If you want to learn more about what that looks like, check out the link below called the 9 Habits of Successful Investors. Thank you for watching, and I will see you in the next video.